What if I told you there's a way to triple your returns from the stock market? No options, no complicated trading strategies. Just one ticker, click buy, and boom, 3x exposure to your favorite index. Sounds like a cheat code, right? Well, not exactly. Because while leveraged ETFs actually do exist, and yes, they can boost your returns, but they can also do something else. They can wreck a portfolio faster than you can say compounding losses. So today, we are going to dive deep into the world of leveraged ETFs, what they are, how they work, why they are so tempting, why some investors swear by them while others have been completely wiped out by them. And if you're someone who's actually searched how to profit faster from stocks and stumbled onto something like the TQQQ or the SPXL, this video might give you a better perspective. So let's get into it. First things first, what exactly is a leveraged ETF? Now, if you've bought an ETF before, you know the drill. You put money into something like the S&P 500, let's say the SPY, and it moves together with the index or the market. So the market goes up 1%, your ETF goes up 1%. Simple, but a leveraged ETF, it doesn't just stop there. So these funds are actually designed to amplify your exposure. Some offer 2x, others even 3x. That means if the index you're tracking moves up 1% in the day, a 3x leverage ETF should go up by 3%. You make more money faster. Sounds great, right? Except what happens when the market goes the other way? Because that same 1% drop in the index actually becomes a 3% loss for you. And if things actually get choppy, bouncing up and down within a range, you might be in for an extremely bumpy ride. And here's the key detail that most people miss. So leveraged ETFs are designed to match daily returns. Not weekly, not monthly, daily. That means they reset every single day. So the longer you hold on to them, the more your results start to drift, and sometimes badly. So let me show you what I mean. Now, imagine you're holding a 3x leveraged ETF that tracks the S&P 500. And in an in a black swan event, the index drops by 10%. And that's pretty rough. But your ETF, it's down by 30%. So it gives you 3x exposure. Makes sense. On day number 2, the index actually rallies 11.1%. And that brings the index back to where it started. So you'd probably think that the ETF also bounced back too, right? Well, not really. So your 30% drop on day 1 took your $100 investment down to $70. And your 33.3% gain the next day, that's 33.3% of $70 base, which brings the ETF to $93.30. So even though the general index is flat, your leveraged ETF, it's down nearly 7%. And that's exactly what we call volatility drag. And it's one of the biggest reasons why leveraged ETFs are misunderstood. So they're not magic money printers. They're just mathematical instruments, and compounding actually works against you when the market gets extremely volatile. And to help cope with the volatile markets, we have just launched a weekly newsletter called Investing Bites, where every issue delivers bite-sized lessons, timeless investing principles. At the start of every month, we will highlight one company we are tracking closely, complete with our own breakdown and why it matters. And it's completely free, and when you subscribe today, we'll send you the latest issue of Investing Bites directly to your inbox. So just hit the link in the description below, and I'll see you on the other side. Now, back to the story. You'll find people online, whether it's on forums or even Reddit, bragging about how they made 30, 50, or even 100% in a few weeks or few days, using these leverage instruments, for example. And to be fair, they're actually not lying. And to give you some context, during the bull run after 2009, the SPXL, the 3x S&P 500 ETF, actually crushed it. It outperformed the regular S&P by more than 7x over a 10-year time horizon. And this leads to a very reasonable question. If the stock market tends to go up over time, and a leveraged ETF can triple those gains, isn't this just indexing on steroids? And there's actually a growing camp of investors who buy into this idea. Over long periods, in a trending bull market, the math actually works in your favor. Volatility drag, which we just talked about, becomes less of a concern when the markets are steadily climbing. And instead of eroding your gains, leverage actually starts compounding them. And you've seen that just in the real world, not just in theory, by looking at the SPXL 15-year chart history. And some backtests even show that if you have invested consistently into a hypothetical 3x S&P 500 ETF, going all the way back to the 1920s, if you have held through the Great Depression, the World War II, the oil embargo, the dot-com bust, and even the '08 Great Financial Crisis, you'd have probably outperformed the general index dramatically. And why? Because over time, the market has an upward bias, and leveraged ETFs, for all their flaws, actually exploit that drift aggressively. And it's not just about buy and hold either. So investors who dollar cost average into these products, say maybe a monthly contribution into the TQQQ or the SPXL, they may actually smooth out poor entry timing, while also capturing the amplified upside of a strong market. So if you have the stomach for volatility, the returns can actually be extraordinary. Then, there is a modern day safety net. A single day 33% crash in the S&P 500 would technically wipe out the 3x ETF. But it's not likely. Even in the worst market crash of all time, Black Monday in 1987, the S&P only fell by 20.5%, a single day candlestick. And since then, circuit breakers have been put in place. In today's market environment, if the market falls 7%, trading actually halts. They fall another 13%, there is another pause. And at 20%, the market actually shuts down for the day. In other words, the very market structure is designed to prevent this kind of catastrophic overnight wipeouts. So yes, there is a steelman argument to be made. If you believe in the long-term growth of the US economy, which will then translate into the US stock market, you have decades ahead of you, and you can emotionally and financially withstand this sort of massive volatility and drawdowns, then a leveraged ETF as a small part of your portfolio might not be insane as it sounds. But even with all these in mind, the back-tested outperformance, the DCA strategies, and the low probability of a single day wipeout, there are still some very real and valid counterpoints. First, the past performance isn't predictive. So SPXL, which is the 3x levered ETF, had spectacular returns that happened during a near perfect macro environment. So there was cheap money, low inflation, low volatility, and one of the longest bull run in the market history. So if we move into a new regime, maybe something like a lost decade of the 2000s, or worse still, Japan's decade-long stagnation, leveraged ETFs could not just underperform, but punish long-term holders. Second, leverage actually multiplies not just returns, but also your emotions. So ask yourself, touch your heart, watching your stock portfolio drop 50 to 70%, even temporarily, in a short span of time, is it really something most investors are built for? So buy and hold actually sounds noble in theory, but when the volatility actually hits, many end up panic selling at the worst possible time. And finally, this entire strategy assumes a kind of economic continuity that we cannot guarantee. If we enter a highly volatile world, spurred by sticky inflation, tightening central banks, or geopolitical instability, then the very mechanisms of leveraged ETFs start to work against you. The rebalancing becomes inefficient, whipsaw movements erode gains, and the structural tailwinds that made leveraged ETFs so successful in the last cycle may not actually be blowing in the next. So let's take a step back. Why do people still flock to these funds? Honestly, because they're simple. So unlike options trading, you don't need margin approval. You don't need to understand the Greeks or even build a multi-leg strategy. You just need to open your trading app, search for a ticker like the TQQQ, and buy it like a stock. Simply put, you get leverage without needing to borrow. And in a world where many people want fast money, that's a pretty tempting pitch, I must say. Now, let's be fair. Leveraged ETFs actually do have legitimate use cases. Traders sometimes use them for short-term speculations. They can be part of a strategy to hedge, or even amplify short-term bets, or even execute volatility plays. But here's also a major problem. Let's talk about their fee structure, because this is another silent killer. So most regular ETFs have an expense ratio of 0.03%, maybe to the max 0.2%. And leveraged ETFs, you're often paying 0.8 or even 1%, or even higher in some cases. And that may not sound like much, but over time, it actually compounds. And because these funds actually use some sort of a swap and derivative, they will also incur transaction costs, slippages, and even rebalancing costs, all of which would be passed on to you as the buyer of such ETFs. And finally, not to just look at the glamorous side, some of these leveraged funds actually get shut down if they underperform badly enough. So there is a certain level of survivorship bias there. Others might undergo a reverse split, where 10 shares get consolidated into one, just to keep the price above water. So if you ever see a 3x ETF trading at $2, I think there's a reason for that. So, should anyone ever use leveraged ETFs? I think we should just look at them like tools. Like a chainsaw, in the right hands, used for the right purpose, it's very effective. But hand it to someone that doesn't know what they're doing, I think you get blood, not wood. So today, if you're going to even consider trading leveraged ETFs, I think you should ask yourself some of these questions. Do I understand the product's mechanics? Do I have a clear thesis? Do I have a stop loss or even exit plan? Am I risking money I can afford to lose? And if the answer to these are no, then I think you might need to rethink your strategy. So if you are here because you want to make money faster, I get it. The temptation is real, and leveraged ETFs actually sound like a dream come true. But just remember, shortcuts in investing usually comes with sharp edges. So what's the final verdict? Are leveraged ETFs financial miracles or ticking time bombs? Well, they're both, depending on how you use them. In bull markets, leveraged ETFs can soar to incredible heights. But in volatile or even bear markets, they become financial weapons of mass destruction. In short, they magnify volatility, magnify fees, magnify complexity, and above all, magnify risks. So they may have a small role to play in the investing markets, but for most investors, particularly beginners or those seeking reliable wealth creation, they are simply not worth the risk. So the next time you see someone promising 3x returns with just one ETF, step back, pause, and ask yourself, what's the real cost of this shortcut? And with that in mind, this is CK from Piranha Profits signing off. Till next time, keep winning.